Hi. In today's world, a woman who controls her finances controls her future. Financial independence is not just about money, it's about freedom, security, and confidence. However, many women overlook financial planning, and in this process, they put their future at risk. Women are managing careers, they are managing families, they are managing individual aspirations and dreams. But what about financial security? Smart financial planning is not just about the money. It's the key to independence today. In this video, we'll break down simple yet powerful steps to help you take the control of your finances and build a secure future. Let's get started. Hi, I'm Jigisha Thakkar, a consultant and a corporate trainer with more than 23 years of corporate training as well as industry experience. I specialize in finance, financial modeling, advanced Excel, risk management, data visualization with Power BI, Tableau, ClickSense, data analytics, and related areas. With a strong academic background, including Associate Company Secretary, MBA in Finance, FRM, and completion of all the three levels of CFA, I am very much passionate about empowering professionals with the right financial and analytical skills to drive informed decision making. Let's unlock the power of financial insights together. Let's go through the coverage of this session. We'll understand the fundamentals of investing, risk and return characteristics, liquidity characteristics of various assets, how inflation is impacting our returns, what are the key steps that we can follow in the journey of financial planning, how we can build the financial independence through diversification of investments and meet our financial goals, how we can leverage the technology and digital platforms for easy investments and smart net worth creation, how we can set the financial goals, align with the investment strategies as well as the different stages of life, and how we can secure our long-term financial wealth. Overcoming the psychological barriers and understanding behavioral aspects of investments, and how we can prepare for the financial freedom and life after that. In this section, let's discuss about fundamentals of financial freedom, how risk, return, and liquidity characteristics of different investments impact the returns that we desire and our financial goals, why financial planning matters for women, and what are the key steps that we should keep in mind for financial planning. The financial freedom actually impacts our ability to live our life without worrying about the money. It's actually having enough income, enough savings and investments to cover our expenses and live the life that we desire. In the key elements of financial freedom, the very important aspect is that the lifestyle that we desire should be maintained. Comfortable lifestyle with an ability to maintain desired living standards without any financial stress is very important. We should have the control over our finances as well as our choices. Having enough income to cover our expenses without relying on the active sources of income, for example, salary or business, or money provided by other members of our family. No dependence on the active income. The passive income in our portfolio will help our financial freedom. For example, we may get rent from the property, we may get the dividend from the stocks, we may get the returns or interest from fixed deposit, recurring deposits, and similar investments. Debt-free status. Does that mean that we should not have any debt? No. The meaning is that we should not have very high interest paying liability. So, very important that don't take the kind of loans or debt or credit cards which can have a very high interest, because that can hinder our financial stability on the longer term. We should have enough emergency fund so that any unforeseen and uncertain expenses can be taken care of without any worry. Okay, early retirement possibility. If we choose to work only up to a particular age and choose to have a retirement life after a particular age, so the point is that we should not have to work as a compulsion or a necessity. If we want to work after a particular age, it should be our choice and not a compulsion. The wealth should be accumulated in such a way that in future, in a retirement, it can be helpful without worrying about any kind of expenses. Freedom to work by choice, not necessity. And financial security not only for ourselves, but also for our family, which can lead to the peace of mind. Why financial freedom is crucial for women? It has been generally observed that women tend to live longer than the male, and that's why I need more retirement savings. If we see the data from different continents, we can clearly see that the females do live longer compared to the males for approximately 3 to 6 years. If we see Northern America, the average life expectancy of males is 74 years, while for females it's 80 years. In Asia, average life expectancy of males is 72 years, while for females it's 76 years. So generally across the world, it has been seen that the life expectancy of males are smaller compared to the females. If we see in India, the life expectancy for males is somewhere around 70.7 years, so approximately 71 years, while for female it's 73.9, that is 74 years. So 3 years more compared to the males. Though in 1950s, whatever was the life expectancy over a period of time due to medical and technological inventions, we can see that the life expectancy is growing for male and female both. However, for females, it's even more compared to their male counterparts. And in future, we may also expect that the overall life expectancy will keep on increasing. Apart from that, the females generally have career breaks because of maternity, because of children, because of caregiving to not only children, but sometimes to the elderly people in the house also. And that's why they need financial planning to stay secure over a period of time. It has also been seen that generally the women may earn less than the men over the lifetime. As per a survey, the Indian woman earns 40 rupees for every 100 rupee earned by men. And if we see that in the leadership positions, only 37% of the female workforce, okay, they are in the leadership position, which is even lesser than this previous year. So in 2024, it's around 36% of the female are into the leadership. And we can also see that generally the female are dependent on the family members or the spouse for the financial independence and decision making power. Most of the times, even if a female is purchasing a house, there will be a joint name of the male counterparts in the family rather than another female. It's also sometimes for financial decisions, where to invest, how much to invest. The decision making power lies with the male members of the family rather than the females. Inflation actually is taking away all our money over a period of time. If we are investing 100 rupees today and there is a 6% inflation, the expenses that we had to have, the things that we used to purchase in 100 rupees, now for the same kind of things that we will need 106 rupees. So money in the savings account will not be sufficient. Savings accounts generally give the returns to the investee somewhere around 3.5 to 4%, while the inflation is 6%. And that's how the purchasing power of the money is not being taken care of. Apart from that, women generally tend to prioritize family over their own finances. And even if there is an awareness, even if females are better able to handle the investments and finances, there is a lack of confidence in the investing. Emergencies and uncertainties come at any point of time in the life. So it's very, very important that we should be financially free for that. We should be having enough funds for the emergencies. We should be having the enough funds for the uncertainties. Now, when we talk about investments, what are the important aspects that we should keep in mind? One is the required rate of return. And these returns we should consider after tax. Apart from that, inflation, this can be actually reducing the purchasing power of our money. Ability to take risk. There will be certain people who would be more willing to take the risk, and certain people who will have the experiences in the life such that they may not be wanting to take more risk. If somebody has seen the loss on the investments during the financial turmoil time, then investments in the stocks may become very risky for them psychologically. And that's why they may not want to take more risk. Okay. Liquidity constraints of the investments and the power of compounding. These are the 5 aspects that we should keep in mind. Let us see all of these 5 aspects with the Excel-based calculations and numbers. So with this, let's understand some things which can help us in calculations, which can also help us in understanding the numbers, and based on that, we can take the decisions. So let me take you through some examples. Okay, let me take you through some examples for this. So as we can see in this file, I have many Excel sheets, Excel worksheets, and we are going to work on each of them for understanding different aspects of investments and financial planning for women. The first aspect that we talk about returns. So first of all, we need to know, what do you mean by returns? Returns are actually the income that we generate on our investments. Now, until these investments are disposed of, that becomes the unrealized gains or losses or unrealized returns. But the moment that the fixed deposit is, let's say, matured, or any stock is there that you sell, so on realization, on getting our money back, it becomes a realized return. Now, let's take an example. Let's say there is one investment which is being done on 1st January 2013, and you did an investment for 50,000 rupees. Now, on 28th of March, the same investment, now this investment could be either in the fixed deposit, this investment could be in the National Savings Certificate, this investment could be in stocks, these investments could be in mutual fund, any kind of investment opportunity that you have done the investment. And on 1st January, if this was 50,000 rupees, and on 28th of March 2025, if this became 1,75,000 rupees, practically the investment became 3.5 times. So 350% of the original value. But if we talk about returns, so if we take out this 50,000 rupees that we invested earlier, let's do -1 for this. This is taking out this 50,000, so it will be actually 1,25,000 over 50,000. Now 1,25,000 over 50,000, this is nothing but 250% returns, 2.5 times of the returns. But is this the correct way to do the calculation? No. The reason is that this is ignoring something called as time value of money, which means that at any point of time, yes, after nearly 12.24 years, now this I've calculated with a function called as year frac. So in Excel, you have a function called as year frac, which is calculating the fraction of the year. Now our investment started at 1st January 13, and the investment is actually valued, or investment is realized on 28th of March 2025. Okay, this is the end date. And each year we are getting the interest based on actual by actual. Now, actual by actual means that total actual number of days, and every year has a calculation based on actual number of days in a year. So if I take actual by actual, okay, 12.236. Now let me just reduce the decimals for this. So this is somewhere around 12.24 years. So this 2.5 times of returns that we are getting, that is over 12.24 years. So it's not every year, it is over 12.24 years. Now let's find out that how this is going to be calculated, or how do we identify that whether these investments is worth or not, how much returns that it is generating for us. So in Excel, you have a function called as rate. Now this function calculates the rate on your investment, considering that you have done one-time investment and disposed of in one time. For how many number of periods? NPER is number of periods. So we are having 12.24 years. Now PMT means payment per period. If you have done the investment for more than one times, we will take an example of this later, but more than once if you have done the investments, then this PMT will be considered. At this point of time, we are talking about a single cash flow, which means a single time of investment and single time of disposal. So PMT at this point of time will be 0. Now PMT is used in the events like annuity payments, like you may have EMI for your housing loans or recurring deposits investments or similar kind of things, or let's say SIP that you do. Here we are not taking PMT because we are talking about one single cash flow. Initially we are doing payment, and that's why I'm putting a minus sign to incorporate the cash outflow. So you are doing 50,000 rupees cash outflow on 1st January 13, and on maturity you are receiving 1,75,000. Okay, let's assume that all of these cash flows are happening at the end of the period. As any which way, this is a one single time cash flow, it doesn't matter beginning or end. Okay, and let's close the function and let's press enter. So this is somewhere around 10.78%. This is the return that we get. Now let's also identify manually that how this is calculated. So we do equal to, then 1,75,000 divided by 50,000. This is 3.5 times. Now this particular investment became 3.5 times over 12.24 years. So raised to 1 divided by 12.24. Now this will give us the idea about how much percentage time that it grown. The investment of 50,000 grown to 1,75,000 over 12.24 years. So annually, how much this is giving us the returns. And also take out -1. Why -1? Because we want to take out this 50,000 rupees which we invested earlier. So this is calculating 10.78%. Okay, the same way that you can also do that, there's 3.5, which is nothing but 175 divided by 50,000. This gives you 1.1078, and this 1.1078, from that we deduct 1. So we get 10.78%. Now this calculation is also called as cumulative annual growth rate or compounded annual growth rate. So every year, on an average, after keeping in mind the time value of money. Now the time also has actually some kind of value, and in the monetary terms, how you are going to calculate. This is a simple idea of that. So 10.78% on an average. Okay, we are getting certain returns, and that is 10.78%. Now this return that we have got, this we should be actually comparing with the other benchmarks. In case if this return or this investment was in stocks, then we may want to compare the returns that is generated on a broad-based index like Nifty or Sensex. If this is in an FD, then probably we may want to compare it with risk-free rate, which is a government security rate. Or if we have some goals in mind, so let's say if you are thinking that, okay, I should be getting at least 12%, then in this case, 10.78 is not enough. So if we talk about the first scenario, let's say Nifty or Sensex. So in this case, let's say if I want to identify that how much is the return that is generated by Nifty, I will just write Nifty here. Now in Office 365 version of Excel, Microsoft 365 version of Excel has these data types. So I will just click on the data type. So in the data tab, you are having this data type stocks. I'll convert this over here and let's find out what is the price or what is the Nifty level as on. I'll just cut from here and I'll put it here. Let me just paste it here. Nifty 50. Okay, and let me just find out the stock history. So stock history for Nifty stock for start date and end date both, including 1st January 2013. I'm not taking any other parameters at this point of time that we will see in the next exercise. So as on 1st January 2013, Nifty was 5,950. Okay, and the same thing if I'm copying and pasting for Nifty again for 28th of March 2025. So this is somewhere around 23,519.35. We already know that between these two dates, the year fraction is 12.24 years. Now, if you want to calculate the return on Nifty, how do we calculate? So the closing value as on 28th of March 2025 is 23,519. And at the beginning of our investment, it was 5,950. Okay. This entire investment over 12.24 years minus 1. So the CAGR, cumulative annual growth rate, the CAGR on Nifty is 11.88%. Okay, we can also calculate the same thing with the rate function. So rate, number of periods 12.24 years. PMT, payment per period is 0. We are only talking about the one-time cash flow minus 5950. Why minus? Because we are investing. So there's a cash outflow, comma, and this is becoming 23,519 and enter. So this is also 11.88%. Now, if this investment was in stocks and Nifty is generating 11.88, that means there is some problem in our stock selection. We should be at least getting what the Nifty is giving us. Then only the investment in stocks will be fruitful. Let us say if this was in FD or some other risk-free instruments, then the risk-free rate, okay, this is usually the government security rate. So let me just take you through the government security rate calculations that we can find from the market. So let's see this. So this is investing.com, and on that we are finding 10-year government security yield. Now this is 6.58%. So as this is 6.58%, and we already know that our investment, the return on our investment is somewhere around 10.78. So 6.58% versus the 10.78%, definitely we are generating the excess return, or this is also called as alpha. So we are generating 4.2% more compared to the risk-free return, which is a good thing. Okay. And if you're expecting that minimum, how much that you should be generating? So minimum required rate of return, which is also called as, okay, minimum required rate of return, which is also called as hurdle rate. So if you're expecting, let's say 12%, and against that 12%, if you've got 10.78, then this is lesser than your expectations. If you were expecting 8% and against 8%, if you have got 10.78%, then there's a good returns. So this is how that we should be looking at the returns. Now this CAGR that we have got, okay, this can be also calculated for the investments which can be over a period of time. So here in this first case, what we have done is that 1st January you did the investment, and 28th of March 2025, it got matured. In the other cases, when you are having the investments like, let's say in stocks, every period you may want to check that what are the prices changes. So for example, in this case, let's say on a zero date, today, or let's say 6 years back, today, let's say 6th year, the closer of the 6th year, the last day of the 6th year. So 6 years back, when you did an investment of 10,000 rupees, after 1 year of investment, you checked that what is the value of this entire investment. 10,000 rupees grew to 11,200, and this has become, let's say, 12% return. Now, how 12% return? 1,200 extra on this 10,000. So this is the return that we are getting is the 12%. Now, next year it became less. So there is a negative return, 4.5%. So 10,700, so this 11,200 got reduced to 10,700. So that's a negative 4.5% return. Similarly, if we talk about every year, from 10,700, it became 13,000, then 14,200, then 15,500, then 17,500. So these are the rates of returns every year. Now, instead of this, if I actually want to calculate the average return of all the years, okay, let me calculate the average return of all the years. And if you see, this is 10.1. It talks about 10.1, but there are certain years where there is negative return. There are certain years which is very, very high return. So is this a good way of calculation? So this is one way of calculation, which is also called as arithmetic average. This is called as arithmetic average. More important than the arithmetic average is called as CAGR, which is cumulative annual growth rate or compounded annual growth rate. The same way as we calculated previously, if I take 17,500 over 10,000, okay, and let's take this for 6 years. So it grew to 1.75 times in 6 years. So as we can see, this is talking about 9.78% returns. The other way that we can also calculate is the same way. We can use the rate function over here. And one more way that you can calculate is this way. So this 12% we are going to add 1 to it, which means that every return that we have got, we are going to add 1 into it. So all of this, let me just do this calculation for you, equal to 1 plus these returns. This is how that we are going to take. Each of these we are going to take 1 plus 1. Okay. And then over a period of time, how this has grown. So if we talk about this, no return to 12%. So for 1 year, you have got 12% return. For 1 and 2 years, as we can see from 10,000, it became 10,700. So we are using a product function over here and 3.44. So this is just a 3.44%. Now it may look like that this is 3.5, but why we are talking about 3.44? Because this is also incorporating the time value of money. So product of the returns plus 1 over a period of time and calculating the root, which means that because this is 2 years, it's square root. If we talk about 3 years, it's the cube root. So raised to 1 divided by the number of years minus 1. Now, this is how that we calculate for the cumulative annual growth rate. So in the first year, the cumulative annual growth rate was 12%. In the second year, the cumulative annual growth rate is 3.44%. In the third year, the cumulative annual growth rate is 9.1% because there is a 21% growth rate in the third year. And if we talk about cumulative rates over a period of time of 6 years, this become 9.78%. Okay. The same thing you can also calculate it differently. So there's a different way of calculation that you invested 10,000 rupees. You did not get any cash flow in the 6 years. At the end of the 6th year, you actually withdrew this 17,500 or you disposed of your investment at 17,500. So the IRR, the internal rate of return for entire calculation or entire investment is somewhere around 9.78%. Okay, you can also use this instead of 1, 2, 3, 4, 5, 6. You can also use this based on the dates. So let's say, for example, 31st December 2018. Okay, if this was your investment date and every year. So I'm just using a function called as eDate. eDate means extension of date. Okay, and every year, which means 12 months, we are adding from the previous date. Now let me just change this to the formatting for the date. So I pressed Control Shift 3. You can also get it from home, and in the home tab you are having this short date or long date formatting, so you can do from that also. And if we keep on adding the dates, okay, this is the dates for each of the investment on 31st December 2024. Let's say this is becoming 17,500. So instead of IRR, you can also use a function called as XIRR. Okay, so XIRR actually takes into consideration of the dates and then it does the calculation. So values are this, okay, and dates are this, and enter. So this again calculates somewhere around 9.77%. Now it's slightly one decimal lesser than the IRR. The reason is that this calculation IRR expects each period as a constant period, and this is based on, let's say, 30 by 360 day count convention, while XIRR keeps in mind actual by 365. So what is happening is that even if there is a leap year, let's say 2024 or 2020, okay, actually instead of 366 days, it will take 365 days for the calculation. So that's why it's little smaller. But these are the different ways in which that you can calculate the returns. Okay. The next thing that we are going to understand is the returns for stocks. Okay. Now I am taking into consideration the Nifty as a broad-based index and Reliance Industries Limited as a stock. So in case if you are doing an investment into stocks or mutual funds or government securities or corporate bonds, this is how that you're going to do the calculation of the return. And for the benchmark, which means that your investment needs to be compared with the benchmark. And for that, how you're going to calculate the returns. So I'm first of all going to convert both of these into the stock data type. I'm using Microsoft 365 version of the Excel. And that's why I'm having these data types as stocks. Okay, if you're not having this facility available into your systems, then don't worry. You can get these values from any of the data sources like Money Control or Investing or Yahoo Finance and similar data sources. So I'm right now taking it from stocks. Okay, now Reliance Industries have various no possibilities. I mean, the Bombay Stock Exchange is also there, National Stock Exchange is also there. So I will pick up, let's say, NSE, National Stock Exchange India Limited, and that's stock that I want. So this is converting into the NSE. So as you can see that NSE Reliance, this is the ticker symbol, and Nifty 50 is the ticker symbol for Nifty. Now, if I'm calculating the stock history, so equal to stock history, the stock, okay, and you can get the data for, let's say, last 1 year I want the data. So start date and end date. Start date would be today minus 365. Okay, in case if you are talking about a 5-year return, then deduct the number of days accordingly. You can take E date and then today and then 60 months. Okay, and my ending date is today. I want the data daily. So interval, I want the data daily. Do I want the headers? Yes. So sorry, I've done no headers, but let's say I want the headers. So show headers 1, comma, and what is it that I want? So I want the date and I also want the closing prices. See, in this you can get opening, high, low, volume and closing date. So I'm taking closing date. Now this is the stock history that it is populating. You can see in 1 minute it has populated the stock history. Okay, and here as we can also see, okay, here we can also see for the Reliance. So I'm just copy pasting the same formula here and it's going to generate the prices for Reliance for me. So as you can see here that you are having this closing prices available. Uh, Today is the 31st of March 2025, and latest data which is available is 28th of March 2025, being Friday. And from 1st of April to 28th of March, this is for 1 year data which is available. Now let's calculate the daily returns. So to calculate the daily returns, we will take the newer date divided by the older date. So for example, in this case, 2nd April divided by 1st April, and the data for that. So 22,453 minus 22,462 minus 1. Now this is giving us the returns. And let me just convert this into percentages. So I'm using a shortcut called as Control Shift 5. Okay, this is giving us the returns. And if I'm calculating the same way for Reliance, 1486.95 divided by 1484.78 minus 1. And then Control Shift 5. Now, please remember, in case if you are not having the Excel which gives you these returns and data, don't worry, you can take the data available from stock exchanges from various sources as we just discussed, for example, money control or investing or any other data sources which gives you the same. The point is that we need to identify what is the annual return. Okay. Now in this case, if I want to calculate that what is the average daily return. Okay, so if you want to calculate the average daily return, so I'll just put the value here, average daily return for Nifty. Okay, this is nothing but you just take the average and take all of these returns and enter. So average daily return is 0.02%. And instead of that, if I want annualized return, then there are three different ways in which that it is calculated. Some analysts do take 365 days as a year. Some analysts do take 360 days a year. And majority of the analyst or majority way that it is calculated is 252 days. The reason is that stock market is open Monday to Friday, and on an average somewhere around 250 days are considered to be the number of days in which that the stock market is open. If we are calculating each of this, okay, this is somewhere around 249 days. So 250 is also one way that people do take into consideration. We have got the data for the last 1 year for 249 days. Okay, so either 250 days or 252 days or 360 days or 365 days. Let's see in each of them. So 0.02% multiplied by 365 if I do, this is giving me 8.28% generated by Nifty in the last 1 year. Okay, if I do this average multiplied by 360, then 8.09, and if I take this multiplied by 252, then it's 5.66% only. Okay. However, because we are talking about an entire year, logically it would be a good idea if you take either 365 or 360. So trading returns, those who are doing trading analysis and all these things generally do take 252 days. But yes, we are talking about an entire year. So it's a good idea that either you take 365 or 360. Let's take the CAGR or cumulative annual growth rate for these returns. So on 1st of April 2024, okay, 1st of April 2024, the value was 22,462. Okay, and at the end of the financial year, okay, 28th March, this is 22,453. So if you want to calculate actually the CAGR, okay, 462 to 453, no, not 453, this should be 23,519, sorry. So this should be actually, okay, 23,519. So this is going to give us the returns over the year. Now, how much is the difference? So 23,519 divided by 23,462 and minus 1. So this just gives us the 5%. Okay, this gives us the 5% return or 4.7% return. Let's do it a little differently because we are anyway going to take this as a 1 year. So yes, 1 year CAGR is also going to give us the same thing. So 23,519 divided by 22,462 raised to, now this is for 1 year only, so 1 divided by 1. Okay, so obviously the same, -1, so 4.71%. So CAGR is 4.71% in this case. Okay, and if we take into consideration the average returns, 5.66% considering 252 days. So this is how that the returns are calculated. Now, same way as we have done this for Nifty, we can also calculate it for stocks. So as we can calculate the same thing for stocks, let's calculate the same way. I am calculating the average here. So the average RIL returns, this is equal to average, and I'm putting my cursor here, Control Shift down. Let me just select this, enter. So I've just done the average. Now this is negative 0.05%. Okay, this is daily. Okay, this is daily, average daily RIL returns. Now instead of this, if I just take the annualized rate, okay, this is the daily return multiplied by 365. In case we are taking 365, in case we are taking 365 days in a year, if we are taking 360 days in a year, so this one multiplied by 360. And in case if we are taking 252 days in a year. Okay, so each of this, as we can see, this is the return. Now, if we talk about CAGR, so on 1st of April, 1484, and on 28th of March. Okay, this is coming to 1275. Let's calculate the CAGR for this. So 1275 divided by 1484. Any which way, this is 1 year minus 1. So 14.12 percentages. This is the CAGR calculation. What should you take into consideration for your analysis for the comparison? Best way is that you take CAGR. So 14.12% versus the Nifty average is 4.71%. And now you can see that this 4.71% is even less than the FD which could have been. Okay, so this is last 1 year returns that we should keep in mind. So just a quick recap, what we did was we understood the concepts of CAGR, how the CAGR, which is cumulative annual growth rate, that needs to be calculated. Okay, how you can do the comparison with the Sensex or Nifty or risk-free rate or hurdle rate. And generally the annualized returns you will be able to get from various sources. But in case if you have to calculate, okay, how are you going to calculate the Nifty returns versus the stock returns? Okay, this is about understanding the returns for a particular investment. Now, in the next calculations, we are going to understand the importance of, so we have understood the required rate of return. In the next calculation, we are going to understand two components, post-tax returns and impact of inflation. So let's go through that. Now, let us say your required rate of return is 10%. You may think that after paying off all the liabilities, after paying off the taxes, and what you should get in your hand is 10%. You should get in your hand 10%. If you have invested 100 rupees, at the end of the year, you should be getting 110 rupees, but that should be tax-free. Okay, you should have already paid tax out of your returns and you should have also adjusted the inflation. So let's call this as real return or real post-tax return. Let's assume that in a year, there's a 6% inflation expected. That means to get the same purchasing power of the money, you should at least get 16% return. And this we will call it as nominal return. So nominal return are nothing but real return plus inflation. Now, there's a very simplified equation of this. Okay, this is a simplified additive equation. Additive means it's just doing an addition. But there's one more equation which says that 1 plus nominal rate is nothing but 1 plus real return or real rate, let me call it as rate, into 1 plus inflation. And this can also be actually, solved. Right now, I'm taking a very simple calculation, which is a simplified or additive equation. So 10% return, if you are expecting, your investment should give you at least 6% inflation adjusted. That means that 16%. Now, if you are falling in a tax bracket of 30%, then this 16% is after tax. So pre-tax, how much you should be getting? Now, let's understand a formula here. Okay. So post-tax return is equal to pre-tax return into 1 minus the tax rate. So now if I want to calculate what should be my pre-tax return, okay, pre-tax return should be equal to post-tax return divided by 1 minus T. Now in this case, how much is the post-tax return that we are expecting? We are expecting 16%. So this 16% divided by, in the bracket, now 30% is the tax rate, which means that we'll be left with 70% of the total return that we earn. So 1 minus 30%. That means to earn the 16% inflation adjusted return, you should at least get 22.86. Let me just add a decimal to it. So this is the same. Okay, this is 16% divided by 1 minus tax rate. So let's just have a very quick overview. In case if your expected return is 6%, okay, after doing inflation adjustments and everything, then you should be at least earning, okay, 8.57%. For a 10%, so from 6%, if your expectation changes to 10%, this goes to 14%. Now let's understand, from 6% to 12%, double. Okay, if your return becomes double, your pre-tax return also becomes double over here. From 8.57, it grows to 17.14. For just a 5% change, if, as you can see, from 10% to 15%. Okay, you see how much is the bigger change over here. From 14, it is directly growing to 21. So as your expectation increases, okay, your pre-tax return requirement also increases. For 35% return expectations post-tax, you should at least get 50% pre-tax, because 30% of this 50% will anyway be taken care of by taxes. So this is about understanding of incorporation of the inflation as well as the tax rate. Okay. So this way you can also see in your investments that how much returns that you are getting. Sometimes what happens that we may think that I'm getting 12% return on my finances, on my investment. But is this sufficient? Because from this 12%, 6% inflation will be taken care of. So you are now left with only 6%. And on that, the 20-30% taxes will be going. So now you'll be left with hardly anything of that. So how much returns that you should be getting on your investments, that you should be keeping in mind. Okay, this is very important from the perspective of investments and the returns that you are generating on that. Okay. Now, we have understood required rate of return, how the taxes are adjusted on that, and inflation. For inflation, I will take you through one more example. So let's understand how the inflation adjustments need to be taken into consideration. Now, in this example, I will take you through, let's say there are 4 women who have done the investment in different asset classes. So Ms. Savita has all of the 10 lakh rupees that she possesses, everything in the savings account. Okay, and 31st March 2015, okay, she has put 10 lakh rupees in the savings account. Let's assume after that there is nothing changed. Of course, from your investments, you may withdraw, you may deposit more. But this is for the understanding of how the inflation is eroding our value of the money. So let's just understand, let's just assume that this 10 lakhs rupees is not touched upon. 10 years before, okay, 31st March 2015, 10 lakh rupees was invested in savings account by Miss Savita. Miss Navita has everything into the fixed deposit. Now, in savings account, the general return is somewhere around 3.5 to 4%, while in FD, current FD rates are somewhere around 7%, 7.25%. So I'm just taking 7% here. So let's say Miss Navita has put the money into the 31st March 2015, and this account is generating 7%. Miss Pravina has put all the money into gold, and the gold returns over a period of time is 11%. Okay. Miss Lavina has put everything in the stock market. On an average, general stock market return in the last 10 years is 13%. And Miss Kavita has put all the money into diversified mutual funds or similar higher return generating assets, and this is generating 12% over here. So the point is that the riskier the investment, okay, the higher the return. Savings account and FD is considered to be relatively safer compared to the other investment classes. And stock market is considered to be a little more risky compared to savings account and fixed deposit. So simple rule of finance, higher the risk, higher the return. Because this investment is riskier, of course, you are expecting the higher returns on that. Now, let us say today, after spending 10 years or after having 10 years of investments, how much is the value that you are getting? So we are going to use a formula for the time value of money called as future value is equal to present value into 1 plus r raised to n. Now in this case, present value is this 10 lakhs and future value is what we are going to calculate over here. So this 10 lakhs of rupees is growing, so multiplied by 1 plus this 4%. Okay, this is growing at 4% for how many years? So raised to for 10 years. So this is growing for 10 years at 4%. And this 10, I'm going to fix this with function F4. So I'm going to make it fixed, which is $D, $8. Now these dollar signs are making this entire cell fixed. As I'm going to drag it on the right hand side, this is always going to take up the 10 for each of these investments. So this 10 lakhs have grown to 14 lakhs 80,000. This 10 lakhs at 7% has grown to 19 lakhs 69,000. This one has grown to 28 and so on and so forth. As we can see, 10 lakhs has grown to 31 lakh if the investment returns are 12%. If the returns are 13%, it's 33 lakhs 94,000. Now, inflation is hitting everybody in the same way. So whatever things that we used to purchase on 31st March 2015, if the same portfolio of goods, if the same basket of goods, if you want to purchase today, okay, it will be at a 6% annually higher rates. So this 10 lakhs multiplied by 1 plus 6%. Now this I am fixing because I will need the same 6% for across all the investments and raised to 10 years. This also I'm going to take for 10 years for all. So this means that if you want to cover 6% inflation for 10 years, minimum that you should have got to maintain the same standard of living. This means that to maintain same standard of living, you should be having the value of your investments going to 17 lakhs 90,000. So what it is telling us? It says that if you want to preserve the value of the money, if you want to preserve the purchasing power of the money, just putting the money into the savings account will not help. You should get the returns which is at least equal to or higher than the inflation. Now, in this case, as it is 7%, while the inflation is 6%, you are just getting 1% more. And that's how your portfolio has grown only to the extent of 1,76,000. While in this case, as you can see, 13% return versus 6%. So you are getting 16 lakhs over here, which is extra. Okay, this is the wealth creation. The point is that if you want to, so the meaning of this is that if you want to cover the inflation part, or you may want to increase the value of your investment, if you want to build the wealth, okay, the savings account or the FD only will not help. Of course, you should have a portion into the safer investments like FD, but everything put into FD or everything put into the savings account will not help you grow your wealth. To grow the wealth, you have to do the investments into the higher return assets. Okay. So instead of investing into one single investment, let's say only savings accounts or only fixed deposit or only gold or only stock market, it's a good idea to have a diversified portfolio. If you have the diversified portfolio, let's assume that you have 20% into savings account, 20% into fixed deposits, 20% into gold, 20% into stock market, and 20% into mutual funds. Then the weighted average of this, okay, that means that you can do this for 20% weightage into 4%, so and so forth. So you have 20% weightage for 7%, you have 20% weightage for 13%, so that comes to 2.6. And when you do the sum of this, okay, you get 9.4%. I have used an Excel function called as sum product. It is doing multiplication and then doing the summation. So it is doing multiplication of these weightages and the returns. Okay, that's how that you can get. So what are the key lessons from this exercise? The key lessons from this exercise is that inflation reduces the purchasing power of the money. And that's why you have to invest into the investments which are at least covering the inflation rate or more. Okay, savings accounts offer low returns while inflation averages in India 6 to 7%. Fixed deposits just covers the inflation. Rates on FD are dependent on repo rates, which are announced by RBI time to time. And of course, repo rates are basically an interest management tool, or you can say monetary policy tool for RBI. So it takes into consideration inflation. Savings alone won't secure your future. Investing wisely helps you grow your money faster than the inflation. And there's a power of compounding. The sooner you invest, the more the wealth gets accumulated. Now, to understand this part, that power of compounding has a great role. Okay, so as we can see, we had certain points discussed over here. So if I, here. So we discussed about required rate, we discussed about inflation. Okay, at one point of time, we have also discussed about power of compounding. So for example, as we are talking about this, so this is cumulative. Okay, the moment you talk about cumulative, you talk about compounded values. So every year, how this is growing. So for 10 years, the compounded value is 1480. Now, instead of 10 years, if this was 20 years, okay, then you can see that instead of 1,76,000, the growth would have been 6,62,000. So this is how that it can be considered. To understand the power of compounding, I will also take you through one more calculation or one more data point. So let me just take you through this. Now, there's a compound interest calculator which is provided by ICICI Pru Life. But yes, this can be from anybody. This is just an example that I'm taking because I found this very nicely presented. Okay, I have nothing to do with ICICI Prudential for this, but logically, I found this good for the explanation purpose. That's why I've taken this. So let's say if you're investing 10,000 rupees, okay, monthly, every month you are investing 10,000 rupees. So this is an SIP that you are doing, or you are putting recurring deposit. and you're investing it for 10 years. So 10 into 12, 120 months. Okay. After 10 years, when your investment is actually, so let me just write 10 here. Okay, you withdraw everything. And this recurring deposit or this SIP is giving you 8%. Then in 10 years, investing 10,000 rupees every month grows your wealth to be 18 lakhs. Now your actual investment without considering the time value of money, it's 12 lakhs. Because 10 into 12, 1,20,000 per year for 10 years. So this is 12 lakhs. Okay, and you got 18 lakhs 42,000. So you got interest on the interest. Okay, now as you can see, at the end of the 10th year, okay, you got 6 lakhs 41,656. This is your earned investment. Your actual value is 18 lakhs 41,656. So this is 18.42 and you got 6 lakhs 41,000. But now let's say instead of 10 years, okay, you don't withdraw this money for another 10 years. So your recurring deposit stops at the end of the 10 years, but you don't touch that money. You keep it as it is for another 10 years. Instead of 18 lakhs, this has grown to 40 lakhs. Okay, so that's how that it works. Let's say for 20 years you are doing these investments. Then this is 60 lakhs, nearly 60 lakhs. So your investment is 24 lakhs, but you are getting 60 lakhs into it. And the higher the investments returns. So here we are expecting 8%, but instead of 8%, let's say you are investing into an SIP or a mutual fund, okay, which is actually giving you 12% returns. Then 10,000 rupees invested every month for 20 years grows your wealth to nearly 1 crore rupee. So the point is that the sooner you start, the longer your investment period, the more the wealth which is getting generated. Let's say both of these are only 10 years. So 10 years investment, and at the end of the 10th year, you withdraw the money. Then this is falling down to 23 lakhs. Return is the same 12%, but this is just 23 lakhs. 10 more years you add into your investments. Okay, and it grows up to 1 crore, which is it increases 75 to 76, 77 crores, 77 lakhs extra. Okay, your investment in this case, of course, will double. It will be 24 lakhs. Okay. Let's say you may say that, okay, I don't have that much money and I don't want to invest 10,000 rupees per month. I will be only able to do only 5,000 rupees per month. Okay, start small. You don't need to worry about starting longer and starting very high amount. Start small. Let's say 5,000 rupees also, if you invest over 20 years, this is becoming 50 lakhs. You may say, okay, I don't have 5,000 rupees. Let's just start with 1,000 rupees. You can save 1,000 rupees from your investments. In 20 years, it will become 10 lakhs. And in 10 years, okay, it will become 2 lakhs. So 1,000 rupees becoming 2 lakhs. Actually, you have done the investments of 1 lakh, which became nearly 2 lakhs. So power of compounding should not be ignored. It's very, very important that you start earlier. Even if you start smaller, that's fine. Even if you start smaller, that's absolutely fine. The idea is to grow the wealth. The idea is to grow the savings in such a way that we can get more than just the savings account. So this is how that I just wanted to share with you about the power of compounding. Now, if we move towards again the next calculation or the next understanding for us, okay, which is about, let's understand, we have still to cover the risk and the liquidity. So just a quick recap, we have worked with the calculations of returns, CAGR calculation, as well as the average returns calculation. We compared it with index and stocks. We also saw how the inflation is actually impacting the purchasing power of our money, and we should be considering the returns after keeping the inflation into consideration. Also after the taxes adjustment. So we should talk about the pre-tax returns rather than the post-tax returns. Whatever returns that we are talking about, okay, when you're comparing stock returns, FD returns, savings returns, all of them are pre-tax. So when you're comparing, it's the pre-tax returns. in your hand you will be getting after paying the taxes on this, on the same. So again, how much tax that you're going to pay, that depends upon the tax bracket in which that you fall. Okay, so this is the one. The another aspect about the investments, okay, whether you should be doing an investment into stocks or whether you should be doing investments into the mutual funds and other things, is being taken care of by two other parameters. One of them is risk, another is liquidity. So when you talk about risk, okay, let's see that you are having 4 different portfolio. Now this portfolio, we will discuss it later. We will discuss after some time about the composition of the portfolio and how you're going to allocate the portfolio, which means that how much you're going to keep the cash, how much you're going to keep the FD, how much you should be keeping in the stocks, that we will see in some time. But let's say you are having 4 different possibilities of portfolio, four different percentages of the portfolio, wherein, no, for example, let's say 20% cash, then let's say 30% debt, or you can say bonds, and let's say another 50% into the equity. I'm just giving you an example, not necessarily that you should be taking this way. Okay, it all depends upon what's your risk appetite and what's your return requirement and at what stage of life cycle or age that you are into. We will see that in some time. But you have portfolios, and each of these portfolio have different components. Now, portfolio 1 gives you 10% in the first year, 12% in the second year, and 14% in the third year. Okay. While if you talk about portfolio B, this gives you 8% in the first year, 12% in the second year, 16% in the third year. Same way, portfolio C and D is giving you the returns. But if you talk about average returns, A, B, C, and D, the average returns are exactly the same, 12%. Now, the question is that should we take portfolio A as our we should be investing into a portfolio A, or we should be investing in portfolio B, or we should be investing in C, or we should be investing in D. So as far as average returns are concerned, and if you only take returns into consideration, okay, then you will say all portfolios are same because they are giving me on an average 12% return. However, whenever you are selecting any investment portfolio, considering only returns is misleading. You should also keep in mind the risk of the portfolio. Now, what do you mean by risk of the portfolio? Risk of the portfolio is actually the possibility of earning the returns. Now, if we talk about portfolio D, it goes to the negative returns also and goes to a very, very high returns also. That means that whenever it's going to give you the returns, it's going to be very high returns. And whenever it's going to give you the losses, it's going to be very high losses. That means it has a very high fluctuation. It may give you, it may not give you. Whenever it gives you, it may give you very high losses or high returns. So the uncertainty in portfolio D is very, very high compared to the other portfolios. Mathematically, this is calculated based on standard deviation. So standard deviation is deviation from the mean. Okay, standard deviation is actually the deviation from the mean. Its mean is 12%, which is the average. And as you can see, the difference, so 26 minus 12, this is 14%. And here also, this is 14%. So there is a 14% up and down of the returns. It is the deviation from the mean. Okay, it has a very, very high deviation. It has a very, very high fluctuation. And that's why this is uncertain compared to the others. Where in portfolio C, the standard deviation is somewhere around 9%. So if we want to see the risk and return, both the characteristics, and based on that, if we want to identify that which portfolio is best, okay, better we take the risk adjusted return. Now, one way of calculating the risk adjusted return is that you just take the return divided by the standard deviation. So you can say that I'm getting 14% returns based on the third year returns, while the standard deviation is just 2%. So 7. Okay, I'm getting 7 times than the risk. I'm getting the returns which is 7 times than the risk. Now, if we are talking about portfolio D, it's just 1.86 times. Now, based on the average return, if we take, okay, this is 12% divided by 2. So this is 6 times and this is 0.86 times. Now, if we are only taking this calculation, which is the returns divided by the standard deviation, yes, this is standardizing your returns based on the risk. It's called as risk adjusted return. But here we are assuming that my expectation is to earn no returns. Whatever return is that I'm getting, that is beyond my expectation. Sometimes you may have some expectation. You may say that minimum risk-free rate I should be getting. Okay, then in that case, this 14% you will not take or this 12% you will not take. But whatever is your return, from that, your expectation you will deduct. So for example, if I'm talking about, let's say, my expectation is 6.7%, which is the risk-free rate, which is the 10-year government security yield. Okay, or for that matter, you can say the returns that I should be earning without taking any risk. So without taking any risk, okay, if I should be earning on these investments, if I put in the FD or if I put in the government security, this is the minimum return that I'm going to get, 6.7%. So obviously what you're going to do is that you're going to actually adjust your return. So let's say if I'm talking about average return, so 12% minus this 6.7%, 5.3. Now this 5.3 you will base with the standard deviation. So this is called as risk adjusted excess return. Okay, and this is in the form of a ratio. The ratio is called as Sharpe ratio. So there is a mathematician, Sharpe. He has given this formula: portfolio return minus the risk-free return divided by the standard deviation of the portfolio. So my portfolio return is 12%. From that, I will be taking out the expected return, which is the risk-free rate, okay, divided by the standard deviation of the same. So this is giving me 2.65 times. Okay, 2.65 times. Which portfolio that we should be selecting? The portfolio which gives us the risk-free, sorry, not risk-free, but the risk-adjusted returns, which are the highest. So the portfolio with the, with the lowest risk, okay, if there are portfolios with the same returns, then in that case, you will choose the portfolio which is having the lowest risk. So because here we are having the same average return, we'll choose the portfolio with the lowest standard deviation. Let us say these 4 portfolio are having the same standard deviation. Then in that case, you should be choosing the portfolio which has the highest return. So if the standard deviation is same, then better you choose the portfolio with the highest return. Like in this example, the standard deviation for all of these things are same. In all the cases, the lowest return that it has gone up to 2% lower than the average, and higher it has gone up to 2% higher than the average. But all of them has the standard deviation 2%. So in that case, you are going to select the portfolio which is having the highest return. So in this case, portfolio D has the highest risk adjusted return. Okay, if we say 22 divided by 2, so it is 11 times, and if I take average return, it's 10 times. If I calculate the Sharpe ratio is the highest in this case. So how the Sharpe ratio is calculated? 20% minus 6.7%, that is the excess return that you are getting. So portfolio return minus the risk-free return divided by the standard deviation. Okay, so this is how that it should be considered. So as we just discussed the points, okay, important points from the perspective of identification of investments: returns, taxes, inflation, risk, compounding. Okay, and another point that we should be taking into consideration is the liquidity. Okay, many a times we will need the assets which are more liquid. okay, rather than something which we cannot dispose of quickly. So we just discussed that the cash in hand or savings accounts gives you the lowest returns. But does that mean that we should not keep anything in the hand, or does that mean that we should not keep anything in the savings account? Not necessarily. For our requirements, the emergency funds will be actually in the savings accounts. So we will also see in next few minutes that how much you should keep in emergency funds, how much you should keep in other investments. So let's understand this part. Cash in hand. If you are having the cash in hand, it has the highest liquidity. Very, very high liquidity. At any point of time, you can use this. Okay. Savings account has the highest liquidity. It's a demand deposit. Okay. It's a demand deposit. So at any point of time, you can withdraw the money from the savings account. Fixed deposit, I would call it as a high to medium. The reason is that though it is anytime you can withdraw the money, but it has a penalty. So if you withdraw the money, you may get the savings rate instead of the FD rate. So high to medium liquidity. Sometimes we do not want to dispose of the FDs, or we do not want to withdraw from the FD, because if we withdraw before the maturity, we may not get the interest that is promised. Okay, same I would put it for recurring deposits. Recurring deposits, whatever is the amount that you have put into it, you can withdraw, but instead of the RD rates or FD rates, you are going to get the savings rates. I will consider equity shares. So if you have done the investment into the equity shares, especially the large cap shares. Large cap shares are the top 250 shares into the market capitalization. So top shares in the market capitalization. So this is the highest liquidity, very, very highly liquid. Daily the trading happens. Mid cap is little less liquid compared to the equity shares. Okay, so it has the little lower liquidity. So I would call it as a medium liquidity. Small cap shares have the low liquidity. So they are not very much quickly traded into the market, or you don't get the volumes, you do not get the very, very high volumes as well as the constant trading on the same. So these ones, so basically cash in hand is in your pocket, it's in the hand. Okay. Savings account, FD account, RD account, usually you will open with a bank or an NBFC, or no, not NBFC. NBFC will not be taking the deposits. But let's say some financial institutions. Okay, banks or financial institutions. While equity, this is something you will be having in your demat account. So primarily you will be doing a trading on either NSE or BSE or other stock exchange. Okay, so this is through your demat account. Okay, government securities will be through your gilt account, which you may have opened with bank. And banks generally do the trading of government treasury bills through the platform called as CCIL. So Clearing Corporation of India Limited. Like you are having NSE and BSE, which is the stock exchanges for equity. Okay, the government securities are traded on a platform called as CCIL. And a huge trading on a daily basis, the banks are doing into it. Okay, similarly, government security also. This is also through your gilt account, but this is just a maturity difference. Government security is for more than 1 year. So 1 year, 2 years, 3 years, 10 years. Maximum trading that happens in the GSEC is for the 10-year benchmark. Okay, this is the highest and the most liquid security, and of course the treasury bill. So both of these has a very, very high liquidity. Okay, from the liquidity perspective, these instruments are highly liquid. You can liquidate this at any point of time. Corporate bonds, again, through your demat account, this is traded on NSE, BSE stock exchanges. And practically, it has been seen that many corporate bonds are privately placed. So it has a low liquidity. There is not much of volume that you are finding, or you won't be able to dispose this off so quickly. Even if the trading happens on the stock exchanges, I would call it as low liquidity, because you are not getting very, very liquid, very good volume of these instruments. Okay, gold, again you can say medium to low. The reason is that any investment in the gold that you have done, mostly this is in the form of either the gold biscuits or maybe in the form of jewelry. And the moment that you purchase it, it becomes a second hand. So you go to the jeweler and then you want to dispose this off. The making charges will be cut, the purity and all will be checked, and you may not get the money the way that you may be expecting. This will be most of the times a distress selling, and that's why you may not get a good value when you are selling it. A good alternative for the gold investments would be the gold ETF. Okay, so if you are investing into the gold ETF, okay, this has a good liquidity compared to gold. The good thing is that, you know, here in the gold ETF, this is a paper gold. As it is a paper gold, what happens is that you get the appreciation in the value, appreciation based on the gold value, and you can actually save the making charges and other things which are getting cut at the end when you are selling it. The other alternative could be the gold savings bonds. And the gold savings bonds are actually issued by RBI. So what it does, it has a 7-year lock-in period. So that's why I would call it as medium to low. But though it has a 7-year lock-in period, okay, it gives you the appreciation in the gold value. And apart from that, it is also giving you 2.5% interest on the same. So you may save the locker charges. Here also you may save the locker charges. Okay, you get the appreciation. In the gold savings bonds, you get 2.5% interest also. The only problem with the gold savings bonds is that it has a 7-year lock-in period, which you don't have in the gold ETF. So at any point of time, you can sell. And it has a liquidity which is higher than the gold, okay, which has a higher liquidity than the gold. If you have done the investment in real estate, please understand when we talk about real estate, we should not consider the real estate in which that we are living. The real estate or the house in which we are staying, the house we are living in, okay, it's not an investment, it's our necessity. Investment means that you have it for the renting out purpose. Okay, now when you talk about renting out purpose, or even for that matter, the house where we are staying, the moment that you want to think about that, okay, you want to sell this off, okay, very, very low liquidity, immediately it won't be sold. You will have to appoint a broker to do the work. You will have to get an agent to get the valuations done. And then sometimes it may take up to 6 months also to dispose this off. So it is low liquidity. Mutual funds has a very high liquidity, okay, equity or balanced, or for that matter, liquid funds. Now, mutual funds are traded, mutual funds are easily liquidated. In the equity schemes, all the amount in the mutual funds are invested into different types of equities. In the balanced, it is a debt and equity composition. And in the liquid funds, it's basically the shorter maturity debt instruments. Primarily, this is either the government treasury bills, okay, either the government treasury bills or government securities or commercial papers or other short maturity debt instruments. So these are liquid. This has a very high liquidity, and then you can dispose this off very quickly. Post office monthly income scheme, I would put it as medium to low, because you cannot dispose of before the maturity. Yes, you can get. So as we talk about post office maturity, it has a lock-in period of 5 years. Okay, in case the death happens, then only the premature closure is possible. Otherwise, at the end of the first year, second year, and third year, if you want to withdraw this, then you're getting 5.5. So basically, you can have it for 1 year, you can have it for 2 years, you can have it for 3 years. These are the returns that you are getting: 5.5% return, 7.6% return. So you have a lock-in of 5 years. You cannot withdraw it before 5 years of into the post office. So this has a low liquidity, not traded in the market. You have to go back to the post office to withdraw. In case of PPF, okay, 15 years, okay, 15 years maturity and extendable for another 5 years. It doesn't allow you the withdrawal, for more than 50%, but that also is possible only after 5 years. So 5-year lock-in you can consider. Maximum investment that you can do every year is 1.5 lakhs rupees. And yes, after 3 years, you can get the loan. Okay, you can get the loan. That loan is also up to the maximum of 25% of your investments, which is done in the PPF. So not traded in the market, you have to go back to the PPF authorities and like that. EPF is also similar to that. And NPS is the National Pension Scheme. So this is again for a very long period of time up to your retirement. At maturity, you have an option to purchase the annuity. So at least 40% annuity you will have to keep, remaining 60% can be withdrawn. And if you withdraw, then you will have to pay tax on that. So if you withdraw more than that, okay, then you will be charged the taxes on that. So complete withdrawal allowed if value is less than 5 lakhs rupees. Partial withdrawal can be done from tier 1 accounts only, and that too after 3 years, that too up to maximum 25% for specific purposes. So this also is a low liquidity. Now the point is that how do you want to do the investments? Okay, do you want to do the investments for a particular purpose? So for that purpose also you need to identify how liquid the investment should be. Emergency funds, okay, should be usually in the more liquid instruments than the others. So you cannot put an emergency fund into the PPF or EPF or like that. Emergency funds can be in the money market mutual fund, or it can be in the savings account, or it can be in the cash in hand. Okay, it also can be in the ETF or something which can be disposed of immediately. So these are some of the points that we should keep in mind, okay, when we talk about the different investments. In the next sections, we will understand the other steps, key steps, and the related value and related concepts. So in the previous section, we understood about the different aspects of investments. We did some calculations around how to calculate rate of return, how to adjust the post-tax, how to adjust the taxes and calculate the pre-tax as well as the post-tax returns. We also saw something about inflation adjustments, the risk calculations with the help of standard deviation, and calculating the risk adjusted return with the help of Sharpe ratio. Then liquidity parameters and power of compounding, how the compounding is helpful in the investments. Moving on, let's understand some aspects about some thumb rules. Okay, there are certain thumb rules for the investments, though it may not be 100% accurate, but if we follow these thumb rules, it helps us making the decisions very, very easy. One of the thumb rule is called as rule of 72. Okay, so it says that whatever is your investment rate or whatever is your rate of return, okay, you multiply it by number of years, that equals 72. That means that, let's say, if you are expecting 10% returns, okay, and you are investing for 7.27 years or 7.2 years, then it's going to become equal to 72. With this rule, you can identify that in how many years your investment will be double, or in how many years you're going to get your returns that you are expecting. So number of years invested is equal to 72 divided by annual investment rate. So 72 divided by 10 if you do, okay, the thumb rule, the rule of 72 says that 7.2 years that you have invested. Though it is not 100% accurate, because actually based on the calculations that we do with the time value of money functions, like we had done one calculation. So let me just take you through that. Okay, we had done some calculations over here while calculating the returns and the 1 minute, please. We just discussed about inflation adjustments and all, and we had done some calculation about 10 years. Okay, and so like this, let me just show you some functions over here. Okay, if I talk about, let's say you are investing 10,000 rupees today, Okay, and you're going to get 10% return on that. So if you are investing it for, so in how many years this is going to become double? If I want to identify, double means 20,000. Okay, so for that, we can use a function called as NPER, number of periods. Okay, at 10% rate for one time investment that I do. So one time investment is 10,000 rupees. This is not going to be every investment. PMT is for every SIP or EMI or recurring deposit or something like that. Instead of that, if I am doing an investment once and this is going to be 20,000 rupees, okay, at the end of certain number of periods, but it is giving me 10% return. So in how many years this is going to become double? So this is telling us 7.27. Now, actually, when you do this calculation, okay, this is coming to 7.27%, but our thumb rule, okay, rule of thumb says that it's 7.2. But that's fine. I mean, at least it's give us some idea. Similarly, let's say if I want to find out that if my amount is becoming double in 7.27 years, then what is the returns that I'm getting? So here we have used a function called as NPER. Previously, we have used a function in the previous calculations as PV and FV and all that can be used. But let's say I want to find out the rate. So we have used this function previously, rate. Okay. Number of periods, so 7.27 years. And initially, I am paying 10,000, but I'm getting 20,000, okay, in 7.27 years. So what is the rate of return that I'm getting? 10%. Okay, so you can use a function rate. If you want to find out that how much should I invest to get the double value, okay, or rather instead of double value, you can say to get rupees 20,000, okay, at 7.27 years, which is growing at 10%. So for that, you're going to use a function called as PV. What should be the PV? What should be the present value of my investment? So how much that I should invest today? So PV, okay, I should be investing. So I'm getting 10% return, okay, for 7.27 years. And I'm not paying any EMI or SIP. But in future, I'm going to get 20,000 rupees. So 10% return, 7.2 years investment, 20,000 at the end of the period that you are getting. How much that you should be investing today? So you should be investing 10,000 rupees. Okay, and if I invest 10,000 rupees today, okay, in 7.27 years at 10%, what will be the future value? Now for that, you can use a function called as FV. So here we have used NPER, rate, PV, and the fourth function that we are going to use is the FV, okay, which is future value. So FV at 10% rate, 7.27 years, no EMI, no SIP, it's one cash flow, okay, and then this is going to be growing up to, okay, yes, this is actually that I'm investing right now 10,000 rupees. But because I'm investing, I'll just put the minus sign here because that's a cash outflow. In these functions, one side of cash flow should be cash outflow and another side of cash flow should be cash inflow. So this is 20,000 rupees. Okay. Coming back to what we were discussing. So let me come back to what we were discussing about the rule of 72. So it says that if you are investing certain money and it's going to get double, so for that you can use this 72. Number of years invested is equal to 72 divided by annual investment rate. So 72 divided by 10, if you do in 7.2 years, it is becoming double. Okay, actually as per our calculation, this is 7.27, but yes, that's an approximation, that's fine. So if the investment rate is 1%, in 72 years, it will become double. If the investment rate is, let's say, 20%, then in 3.6 years, it's going to become double. And if the investment rate is 30%, then in 2.4 years, it's going to become double. For 4%, it's going to become double in approximately 18 years. So this is one rule of thumb. There are other rules of thumbs also. So let me quickly take you through that. That for doing the investments, what are the other things that you should keep in mind? First rule of thumb is 100 minus age. So you should be doing the allocation to the equity based on 100 minus age. After some time, after a few minutes, we are going to discuss this rule in detail, keeping in mind the portfolio allocations which is done in NPS, or you can say National Pension Scheme. So 100 minus age. For example, if your age is 25, you can safely put 75% of your portfolio, and allocation can be up in the total investment portfolio. 75% can be given to equity. Now again, there's a rule of thumb. So not necessarily that your choice may be this, but generally this is considered to be a good idea. Okay, the another rule of thumb is this, that for your retirement portfolio, how much that you should keep in mind. For example, 25 into annual living expenses. So let's say if you want to retire in next 25 years, or let's say you want to retire in some time. At the time of retirement, considering that you are going to live up to another 25 years after the retirement, okay, this much corpus that you should actually gather. So if we assume that your annual living expenditure is 12 lakhs rupees, that means 1 lakh rupee per month. Okay, so your retirement corpus should be, okay, minimum 3 crore rupees, 25 into 12 lakhs, minimum 3 crore rupees, considering that you are going to live up to another 25 years after the retirement. Okay, so that's what that you should keep in mind. And there should be 4% withdrawal or 5% withdrawal from that. Another rule of thumb 72 that we have already seen, that in how many years, okay, in how many years your investment will become double. So 72 divided by 7. In case if you say that, okay, in 7 years I want to make my investment double, then your approximate return that you will have to generate is 10.3. So you are going to do, let's say, 72 divided by 7. If you are expecting that your investment should become double in 7 years, then you should be investing at the rate of 10.3%. So these are some of the things that can be helpful in identifying our investments. Let's move forward and see other things. So other key steps as far as the financial planning is concerned, one rule is 50-30-20 rule. That means how much that you are going to actually keep from your income for your needs, how much that you are going to keep for the wants, and how much that you are going to keep for savings and investments. So the thumb rule says that whatever that you are earning, 50% of that will go into your needs and essentials. Maybe rent, maybe food, maybe utilities, clothes, EMI, insurance. Now, without these things, you cannot survive. So these are some of the essentials for which that you will have to spend. And from your income, maximum 50% that you should be utilizing for this. Okay. 30%, maximum 30%. That you should be spending on your wants and desires. So for example, you may want to go shopping, you may want to go for dining out, you may want to go for vacations. Now 30% of your total income, okay, should go into that. There is one more variation of this rule which says that 50, 20, 10, 20. Now 20 plus 10, okay, the middle portion of 30, okay, middle portion of 30 is classified into 20 and 10. So 20 is for shopping, dining out, vacations, and all those things. And 10 is primarily for personal development and skill development. Now, there are many professions in which personal development and skill development is very, very necessary. Not only that, nowadays, as the technology changes, the way that the entire market operates and the entire job market operates changes, the AI and ML and a lot of other things that comes up. So in that, it's very, very necessary for a person to keep themselves developing. So 50-30-20 rule, in that 30% for wants. But yes, I would say that this personal development and skill development is actually not a want, it's a need. It should go into the need section. So 60% in the needs, I would say. Okay. Personal development, skill development, 10% of your total income must be kept aside, because otherwise in future, okay, if we have to survive, for a longer period of time, keeping in mind that the skills are changing, the requirement of the skills are changing over a period of time, it's very, very important. And 20% can go into savings and investments. So logically, whatever income that you get, first 20% you have to keep aside, and another 80% that you have to spend on your needs and wants. Now, this 20% for savings and investment comprises of mainly the emergency fund, which can last up to 3 to 6 months. At any point of time in your emergency fund, which can comprise of savings account, which can comprise of liquid mutual funds, which can comprise of something which can be liquidated at any point of time, this should be at least 3 to 6 months expenses. God forbid something happens and we are not able to work, or if we are not able to get the regular income, then to regularize the thing, to get the cash flow flowing again, we'll need at least 3 months time, 3 to 6 months time. So it's very, very important that we should keep 3 to 6 months expenses in the emergency fund. Sometimes some uncertainty happens, suddenly some medical expenditure comes up, then at least this much amount should be available with us. Okay. We can also keep some of the portion for wealth building, where we keep investing and then we keep on growing our portfolio. These things we have discussed in the previous sections, where we were talking about power of compounding and how 10,000 rupees per month invested for 20 years and giving you 12% return grows up to 1 crore in 20 years. Okay. And it can be also for your retirement planning. It can be for your life after the retirement. We have already seen that women generally live longer, and that's why we need more savings into the post-retirement life. Okay. It can also be for our financial freedom. The earlier we invest, the sooner we can be financially independent. If nothing, at least small amount, 500 rupees, 1,000 rupees, we should keep on investing. Ideal emergency fund size, how much it should be? So as we just discussed, it will be 3 to 6 months of essential expenses is the general rule. However, in certain special situations, instead of 3 to 6 months, it can grow up to 6 to 12 months. For example, if you are the sole earner in the family and the entire family is dependent upon you, you may have dependents like elderly parents or kids with you. And there could be a possibility that in case if your job or income is very, very uncertain and unstable, you don't get the same cash flow every month. There are certain months where the cash flows are higher. There are certain months where the cash flows are very, very low. There are certain months where there will be zero work. So for freelancers, for business owners, this is highly uncertain periods sometimes. So it's better that you keep 6 to 12 months as the emergency funds. So in case if your monthly expense is 50,000 rupees, then nearly three-month fund you should be keeping up to 1.5 lakhs. In case if you want to keep 6 months, then 3 lakhs. And if you want to keep for 12 months, then 6 lakhs. Okay, let's quickly see this. Okay, let's see this quickly, the 50-30-20 rule calculations. Okay, in this worksheet, I have one calculations for 50-30-20 rule. And let's understand what all comprises of that. So let's say, for example, your monthly income, okay, after tax salary or wages comes to, let's say, rupees 1 lakh. Apart from that, you have another additional income like coming from some rental or from some grant or financial aid or maybe some scholarship. Maybe you have a side income from another business. So let's say total it comes to 1,20,000. And from that, your needs or for minimum expenses that's going to go for needs is, let's say, you have to pay rental or mortgage. Now, rental would be in case if you are having a rental house. If you are having your own house, then there could be the mortgages. If you have neither of them to be paying, then you are one of the lucky persons. Okay. So no mortgage, no rent is very, very good situation where you don't need to worry about at least having a house on the head. Okay. Homeowners or renters insurance, in case if you have to pay any insurance, any property taxes. If you have a vehicle, then vehicle insurance, health insurance, medical cost, okay, electricity, gas bill, water bill, any maintenance expenses for home, groceries. Okay, in case if you have any car and if you consider the car as a necessity. Now, some of the people will consider car as the necessity. For some of the people, car will be a luxury, and then they would be going for a public transportation. So if you're going with a public transportation, then that amount, if not, you're having your own vehicle, and if you consider this as a necessity, then that expenditure, maybe the car EMI payment, maybe the parking charges, maybe the fuel charges, all of this will come as the needs. Because most of the times what happens in the cities like Mumbai and cities like Bangalore and metro cities and all, okay, sometimes this becomes very essential that you should be having your own car. But yes, public transportation is also another option. Okay. Phone bill, internet bill. Okay. In case if you are having babies, and then you may have to pay for the baby's expenditure. In case if you are having grown-up children, then you are having for them the college and books and all other things. In case if the children are staying in a hostel, then you may have to pay for the laundry for that also, their books. Now, these are all essential and necessary expenditure. Okay, these apart from, I mean, without this, it will be difficult to survive in the current situations. So let's say in this case, this is 57,283. Now, if we talk about the percentages, 1,20,000 is your total income. And from that 57,283, if this is your needs, then 48%. You are well within the limits. Okay, if we talk about wants, then maybe you may want to purchase some new luxury clothing, or let's say extra clothing. Currently, even if you avoid to purchase them, it's fine. But you want it to have, you may want to have some clothes or jewelry, which is not an absolute necessary. Okay, you may want to go for dining out, drinks, okay, movies and concerts and special meals, maybe gym or club membership. Now, some people will say that, okay, gym or club membership is a necessity for me because I want to keep in mind the health aspects of it. Now, for that also, you can keep in the necessity if you want. I've just kept it in the needs and wants. I've just kept it in the wants side. Okay, I'm considering that you have other options also for the health. So that's why I've just kept it over here. Something for which you don't have any other alternative. But I mean, no, it's very, very important that goes into the needs side. And something that you have the alternative, but still you may want to stick to it. And as per your maintaining of the lifestyle that you want to spend on that. Maybe travel expenses extra. This does not include your daily travel expense, which could be for the office. Okay, cable, streaming packages. Now these are all wants. So let's say this is 25,000 and 1,20,000 is the total income of that, nearly 21%. Okay. So this is also within well limit, which means that for savings now you are left with 31%. And you can do the savings, you can actually work with it. So you can go for 60,000 up to necessities, but now you're well within the limits. You can go up to 36,000 for the wants. The more that you will be curtail on your wants, you will be able to save it for the savings and debt and repayment. Because needs you cannot do anything. But for wants, if you control, definitely you will be able to spend more, or you will be able to invest more for the savings, okay, for emergency funds and future. So now in this case, you are left with another nearly 31%, which goes up to 37,717 from your income. So this is the way that we can use this particular template for identification, how much that we are spending on needs, how much we are spending on wants, and how much we are actually doing the savings and investments. Okay. So this Excel file, this entire Excel file will be available along with this video. You can use it for your purpose. You can use it for your calculations and your own calculation for 50-30-20 rule based on your numbers of needs and wants. Now, the next thing that we need to understand, okay, is we just discussed about what should be the ideal emergency fund size and where can you keep the emergency fund. Okay, you can keep the emergency fund in the savings account. You can keep the cash with you, but it will be giving you 0% returns. While if you put in the savings account, at least 3%, 4% returns that you're going to get. Okay, you can also put it into the liquid mutual funds or the fixed deposits. Nowadays, there are flexi accounts available in many banks where you are having savings and FD combined, which means that above a particular amount, the account gets converted into an FD, and you get a little higher interest rate on the extra amount into your savings account. So that also that's called a sweep account. Okay, you can use the sweep account also for the same. Avoid relying on the credit cards and loans. Many people think that if some emergency comes up, I'm keeping a credit card for the emergency. And if some emergency comes up, at least I'll be using it for payment for that. But credit cards generally attract 36 to 40% of interest rate. And in case if we actually forget to pay, or we are not having enough income to repay the credit card loans or credit card payments, then this goes into a loop. And this is much higher interest rate, even higher than a money lender would be charging to us. So credit cards, 36 to 40% interest that they are charging. Credit card for a routine expenditure, it's fine. Okay, you should keep the credit card only if you don't want it or if you don't need it, because that's something that no, you can, if you are using the credit card, you are swiping the credit card, you are able to repay it quickly. But if you keep the credit card with you for the emergency, and if God forbid if you are not able to repay, it's going to charge you 36 to 40%, very very high interest rate. And this makes our emergencies even worse. On one side, we are not having enough money to pay the emergencies. Another side, 36 to 40% interest rate. This is going to be very difficult. So better we avoid relying on the credit cards and loans, especially for the emergency. Okay. Now, we should also understand that the way that we are doing investments, okay, we should not put all our eggs into one basket. Okay, we should diversify it. Now, what do you mean by diversification? So diversification means that you keep your money into different asset classes. You spread the investments across the different asset classes and you reduce the risk. Now, how the risks are reduced by keeping the money in different asset classes? Let us say if there is a problem in the stock market, and if you have invested only in the stock market, then you're going to lose entire money. But if there is a problem in the stock market and you have put your money into stock market, bonds, cash, okay, it's also there in the real estate and different other asset classes, then the losses in one asset class will be wiped off, or will be taken care of or managed by the profits that's happening in the other asset classes. So if you want to achieve the stable long-term financial growth without any overexposure to one single type of investment, better that you diversify into different asset classes. Now, in what kind of asset classes that you can invest and why diversification matter? So diversification matters because it reduces the risk. Okay, if one asset underperforms, the others may balance the loss. Protection against the market downturns. This is what we just discussed. But apart from that, this improves your risk adjusted return, because the portfolio volatility will be calculated based on the correlation of the assets. If there is a negative correlation between two asset classes, what will happen when the one asset is generating a very high returns for you, the other is generating the lower return for you, and the fluctuation or the volatility or the standard deviation of the entire portfolio will be lower compared to just one asset class. When one asset class is giving you negative returns, the other will give you the positive returns, and accordingly it's going to be balancing out. So for a consistent growth, the consistent returns and consistent risk parameters is important, and mix of assets will generate the consistent growth rate. So this ensures the steady wealth creation. It also aligns with our goals. Over a longer period of time, if we are able to estimate the risk and return, and we are able to consistently grow our portfolio, then this is going to be helping in alignment with our goals. And we have to depend lesser and lesser on one single source of income. So diversification is very, very important. Diversification does not mean only across the asset classes. It's also within the asset classes. For example, you have 30% of your portfolio invested into the equity. And within the equity, you have all the stocks of one particular company, let's say Reliance, or let's say Adani, or let's say Microsoft. One single company stocks is also a high concentration. That also needs to be diversified. Okay, so if you select the stocks in that also, it's very important that you select the stocks of different sectors. Okay, different size of the companies, and different companies returns. So don't rely on only one type of investment. Traditionally, these are the portfolio assets that can be considered for allocation or diversification. One of them is equities. Now, in the equities also, you can diversify among the large cap, mid cap, small cap, blue chip stocks, emerging markets. The second one is the fixed income or the bonds. Now, these are somewhat, it's like you have given the loan to others. So, government bonds or corporate bonds or municipal bonds or treasury bonds that you can invest in. You can also invest in mutual funds. Now, mutual funds have various schemes. Some schemes are only equity, some schemes are only debt, some schemes are a mix of both of them. So, they are called as balanced mutual funds. You have exchange traded funds. You also have cash and cash equivalents like savings funds, FD, recurring deposits, real estate, and the funds of real estate, which are also called as REIT, Real Estate Investment Trust. And you can also invest in gold, silver. Okay, of course, being individuals in India, I've seen that people are not directly investing in oil or agricultural products, but I've also seen many people doing trading of futures of oil and agricultural products on commodity exchanges. Okay, let me take you through some of the things about these traditional investments and their return characteristics. So as we see, okay, these are the historical returns which are generated by these investment assets in the last 10 years. Cash in hand, once the cash is in your hand, it has the same value. Okay, it is not generating any additional return. So it is 0%. But if you are putting the money into the savings account in the bank, it generates somewhere around 3.5 to 4%. In the last 10 years, it's somewhere around 4%. FD rates in 2013-14, it was somewhere around 9.5%. Now this has dropped up to 7%. And in future, it will depend upon how the interest rates are being announced by RBI and how the FD rates or the bankers are reacting to those rates. General estimation at this point of time is that for maybe a few years, the rates are going to remain constant and then it's going to drop. But however, the future will tell that what will be the FD rates in future. Government securities, treasury bills. Okay, this was somewhere around 6 to 8%. So 2013-14, it was somewhere around 8%, and now this has dropped up to 6.7%. Okay, 1 or 2 years back, it was slightly lower than this, but now this has increased up to 6.7%. The latest benchmark, 10-year government security benchmark, we have just seen in the previous sections that it's 6.58% recent yield. Okay. Corporate bonds are somewhere around 7 to 9%, though there are certain corporate bonds are paying you 11%, 13% also. Again, this depends upon the rating of corporates. Okay, equity stocks 12 to 15%, mutual funds 12 to 15%. Gold is somewhere around 9.3%. Okay, real estate. Now, this is one of the investment which being Indians or being in India, we consider as one of the most important investment. But as you can see that the total return that you are getting is hardly 4 plus 3, 6 to 7%, which any FD also will give you. Okay, let me just take you through the historical data for this so that we understand this better. I'll come back to this slide in a minute. But just to take you through about the returns. Okay, so this is the actual data of real estate in India, and this is based on the NHB Housing Price Index, which is for the residential houses. So NHB is the National Housing Bank, and they have an index called as Housing Price Index. Now, again, this is across the country. So there could be a possibility that in certain locations, these returns may not be there. The returns may be much higher. and in certain locations the returns may be much lower, but this is across the country. Okay, and this is based on the price index. So from 2002 to 2010, okay, or rather for that matter, we can see that 2011-12 also, the prices were decent enough. The returns were decent enough. Okay, 2010, it was also 24% capital gains on the real estate. So it was somewhere around 18% to 24%. 2008-9, any which way subprime crisis were there, and it was because of the housing and the mortgages only this subprime crisis was there. So obviously during that time the rates fell down drastically, and maybe 2010 it grew a little bit more, and then it was giving a return of 24%. But after that, consistently the returns have dropped, and last few years it has seen 3%, 4%. 2017 it showed 1% CAGR of housing prices. Okay, 2022 it is 9%, and 23-24 also it's somewhere around 3 to 4% only. So on an average, okay, in the last 10 years, if you see the 4% CAGR of the housing prices. Now, if you are actually investing into a real estate for the rental purpose, okay, so nearly 4% is the annual price growth which has happened in the last 10 years. And apart from that, the rental that you are getting, okay, it's hardly 3% of the total portfolio. So let's say if you are having a house worth of 1 crore, okay, so if you are having a house worth of 1 into 10 raised to 7, if I do, so this is 1 crore, and if I just take 3 to 4% of that, so 3% of that, okay, which is 3 lakhs per annum, and 3 lakhs divided by 12, if I do, 25,000. So this is a usual rate in a metro cities, or you can say the tier 1 and tier 2 cities, that 25,000 rupees, let's say, rent for a 1 BHK. And if you talk about the pricing of that, this may go up to, let's say, 1 crore rupee. So annually, just 3% rental income minus any other expenditure if you do. So any repairing, any maintenance and all these things, these returns will further drop. So real estate is somewhere around, at this point of time, 4 plus 3, 7%, 6, 7%, which you can also get from risk-free returns, or you can get it from FD rates also. Okay. Having said that, yes, real estate and the gold, these two are traditionally considered to be the safe zones or the safe havens for an Indian household, in addition to FD and PF. Okay, these are the safer investment zones which generally an Indian household considers. What I'm trying to tell you is that yes, they are good, but then we should also see the other options which can be equally safer but giving us the higher returns. Now, when we talk about mutual funds for the equity, it's around 12 to 18%. Post office monthly income scheme, 7.5%. That too, in case if you are investing for more than 5 years. And we have already seen that it has a lock-in period for 5 years. PPF, EPF. So EPF, the employee provident fund, which is regulated returns, so 8.25. The returns are quite good in this case. But in the PPF, you are having every year changing interest rate. At this point of time, it is 7.1%. So which asset class is giving you the return compared to the risk? We have already discussed about that. You should not see only returns. You should not see only risk. You should not see only liquidity. You should see a combination of all of them. And it's a good idea to consider the risk-adjusted return. So what's the standard deviation of each of the asset classes? And based on the risk, how much is the return? That's what that we should keep in mind. Okay. Let me now take you through the next aspects of the diversification and the key steps. You have other alternative investments and modern investment options. Like you may want to invest into art and collectibles, you may want to invest into private equity, but for alternative investments, the minimum investment size is very, very high. In many of the cases, the minimum investment size starts from 10 lakhs rupees or 25 lakhs rupees, depending upon your scenario. So if you want to do an investment into the smaller amount, okay, these investments are not available for the small investors. You should be a high net worth individual for that. And these are highly risky investments, highly illiquid investments also. Investing into another startup or investing into another company, investing into paintings or rare coins or luxury is really making your investments to be very, very illiquid. Whenever you want, you won't be able to dispose of the asset. So as a second income, or let's say once your other goals are met, okay, then you may want to invest into these investments for wealth creation. Okay, nowadays crypto and blockchain and peer-to-peer lending, so many other things are there. However, this has its risk and liquidity. My suggestion is that if you are thinking of any of these investments, first please do thorough research for their risks, for their regulations, for their returns, and then you please do the same. Okay, especially when you talk about cryptos and blockchain based assets and like that. In India, at this point of time, they are not legalized. Okay, so it may have the regulatory hurdles also. Once this legalizes, then it can be a good thing to do the investments. But at this point of time, this we need to be little with a pinch of salt. Now, on what basis, based on your goals, that you are going to diversify the assets? So we may have different goals. Okay, of course, the first goal which needs to be considered is the short-term goal, which can be for emergency fund or maybe buying a gadget or maybe going on a vacation or like that. Now, from this, okay, please understand these are short-term goals. I'm not saying these are the most important goals. Short-term, medium-term, and long-term, this is based on the term, and from that we need to identify which are the important goals. For example, retirement may be one of the most important goal, but this is not a very, very recent goal. We don't have to fulfill this tomorrow. We have to create the wealth for it over the long term so that when we retire at that point of time, we have enough funds. Okay, similarly, let's say the house purchase or car purchase, or maybe you may want to go for a higher education. Now, your goal could be that I want to do a higher education, I want to go for a higher education next year. Then it will become a short-term goal. But if you may think that, okay, in the next 4 or 5 years, I want to do a CFA or I want to go for another professional education which is relevant to my profile, then this will become a medium-term goal. Now, from this, you need to identify which are important, which are not important, and then you should apply 50-30-20 rule. But after applying 50-30-20 rule, okay, if you're identifying that in the short term, you may want to go for emergency fund or credit card payment or vacations or something similar to that, then your short-term goal-based investment should be in safer investment and liquid investments. Okay, you cannot put this into the PE funding, private equity funding. You should not put it into the very risky stocks. You should not put it into the real estate. Okay, short-term goals should be in the liquid instruments. So maybe in the liquid funds or fixed deposits or short-term debt mutual fund. Now, medium term can be in the equity or mutual fund or something no, which has a medium liquidity. Okay, high to medium liquidity or medium to low liquidity, but medium liquidity. So maybe gold. Okay, you may also put it into the real estate. Long-term goals, the main purpose is the wealth creation. So you should put it into the little bit of, I mean, it's good idea to put it into those investments which are generating the higher returns for us. So this is how that we should be considering based on goals, which goals that we want to accomplish in the shorter term. It has to be in the liquid instruments, and medium to long term can be going into the little less liquid, highly liquid, that's fine, but higher return generate. Okay, how do we prioritize the goals? And this is also something that we have already discussed in the 50-30-20 rule. We need to keep in mind our needs versus wants. Now, any income that you get or any goals that you may want to fulfill, okay, prioritizing them will depend upon whether it's a need or want. The first thing that you should keep in mind is the need. Now, emergency funds, insurance, retirement savings are the needs. Now, emergency funds can be in the short-term instruments, while retirement savings can be in the long-term instruments. Lifestyle goals can be for travel, for luxury, for gadgets. You may say that, okay, I want to go for a Europe tour in the next 2 years, or I may want to go for a vacation for Northern Lights. Okay, I may want to buy a gadget. I want to purchase an iPhone or iPad or some gadgets which can be helpful. So any luxury, I may want to purchase a car, and that car is a luxury car. So now this is a want. Now, unless your essential goals are fulfilled, you should not think about wants. First, make sure that your needs are satisfied, your needs are accomplished. Then you can go for wants. And after that, you can talk about investing for wealth creation. Sometimes, yes, you can say that wealth creation will go hand in hand along with the needs. Because wealth creation may look like that it's not an immediate goal, but it can be in the long term, can be for retirement also. And that's why we are keeping the retirement savings in the needs. Now, here the growth goals or wealth creation goals could imply that you may want to leave your legacy behind. So when you retire, or let's say when everything is accomplished from the life, when we go from this particular life, when we die, at that point of time, we may want to leave certain assets for our kids, or you may want to do a big donation to another maybe some NGO or maybe some religious organization. So this should be considered, yes, it's an important goal, but it should come after our essential needs, okay, and our other goals that we may have in mind. So prioritizing the goals based on emergency, essential goals, lifestyle goals, and growth goals. Now, when we are talking about goals, okay, goals cannot be vague. You cannot say that I want to have a retirement corpus, or you cannot say that I want to save money. The goals have to be smart. That means that it has to be specific, it has to be measurable, it has to be achievable. Okay, I want to go to moon, but it's not achievable. Okay, I want to go to Mars, but it's not achievable. So align your goals with the income and expenses. Okay, it has to be relevant, it fits to your life priorities, and it has to be time bound. You will have to decide the timeline. So for example, you may say that in the next 2 years, I want to do the Europe tour. Okay, and for that, the expenditure will be somewhere around 5 lakhs rupees. So here what is happening, it's a specific. Clearly, you are defining your want that you want to go for a Europe tour. Okay, and for that, you will need 5 lakhs rupees. Or let's say I want to purchase a house. For that, I will need a housing down payment for, let's say, rupees 10 lakhs, 50 lakhs, whatever amount it is. It should be measurable. So you need to give a target amount and a time frame. It should be achievable. You need to keep in mind your income versus expenditure. Now, if my income is, let's say, 1 lakh rupee per month, okay, and my expenditure is such a way that, no, I may want to purchase a Rolls Royce in the next 5 years. Not possible. Unless you identify some other sources of income. So at this point of time, not possible. That's why you may need to keep in mind that from where else that you can get more income, and then you may want to purchase it. So align the goals with income and expenses. Okay, ensure it fits with your life priorities and have a deadline. So I want to save money is a very, very vague goal. But if you say I will invest 7,000 per month in a mutual fund or some specific investment choice to save 10 lakh rupees in 5 years. Now this becomes a smart goal. So make it specific, make it measurable, make it achievable, make it relevant, make it time bound. So very, very important that your goals have to be smart. The next thing that we can see is that 100 minus age rule. This we have already seen in the thumb rules. Okay, we have already seen about this in the thumb rules, that how much your investment should be in the equity. So we already discussed that 100 minus your age should be the investment allocation to the risky assets like equity or equity funds or something more risky. So if your age is within 30s, then 70% of your total investment you can allocate into the equity or equity funds. If you are in the 40s, then 60%. If you are in the 50s, then a good idea is 50%. Okay. Ideal diversified portfolio mix based on the risk appetite can be something like this. If you are having conservative approach to the investments, which means that you don't want to take more risk, then your major portfolio allocation will be to the debt. Okay, maybe fixed deposits or bonds or PPF or PF or post office monthly income scheme, or some other schemes which are giving you assured income. Okay, so in case if you may want to have a lower risk portfolio, then allocate more towards the surety based investments. If you are aggressive, you want to take higher risk, okay, then in that case this higher investment can be in the equity side. And if you want a balanced portfolio, then maybe a balanced, I mean, no equity 50%, debt 30%, maybe gold and commodities 10%, and like that. Having said that, okay, not only our wish or not only based on what we actually want, we should also see that from where our income is coming. If your income is coming from a risky sources, for example, if you are a stockbroker, okay, or if you are a freelancer, and the income is very coming from a very risky sources, or the income is very uncertain, then better you keep your investment into the conservative portfolio. And if your income is coming from a safer sources, for example, if you are a university professor, or you are a government employee, then obviously your salary is protected, your pension is protected, then the more emphasis should be on the wealth creation. Then even in the retirement age, you won't have that much worry about the income or the expenses, how you're going to meet your expenses. Then in that case, you may want to go for a slightly aggressive portfolio. So one is the wish, another is the risk appetite, and the third is that your income sources, from where it is coming. So keep in mind those things as well. Okay, let me show you quickly one document that I have, and this document is actually the NPS document, okay, National Pension Scheme document, which is actually published by NSDL. And there are various schemes under National Pension Scheme. Okay, so that's what that we are going to go very quickly understanding it. There are 4 asset classes that it talks about. You have equity, you have corporate debt, you have government bonds, and you have alternative investments. So equity is a risky investment. Corporate debt and government bonds are safer investment. Alternative investment fund is again a little risky. And these are the different portfolio managers identified under NPS scheme. Now, this scheme has 2 different choices. You have active choice and auto choice. In the active choice, as a subscriber, you will have a right to actively decide how do you want to allocate your money in these 4 asset classes. So how much you want to allocate in equity, how much you want to allocate in debt, how much you want to allocate in bonds, and how much you want to allocate on alternative investment funds. However, the scheme says that at any point of time, okay, you cannot invest for more than 75% into the equity. You can't say that I want everything into the equity. So up to the 50 years of age, so if your age is 50 or lower, okay, maximum that you can decide to invest into the equity is 75%. And the remaining amount will be invested into the corporate bond, government bond, and the alternative investments. And at any point of time, you cannot invest more than 5% into the alternative investment fund, because that is very risky. So up to 50 years of age, maximum equity allocation is 75%. And for 1 year of increasing age, incremental age, so if you become 51 years, then maximum is allowed 72.5. So 2.5% is the reduction in the equity portfolio allocation with 1 year of age, with 1 additional year of age. So if you are 60 years and above, the maximum that you can put in the equity is 50%. So this is something which is aligning with our 100 minus age criteria. More your age, or let's say you are older in the age, lesser would be the allocation to the equity. Okay, so this is the active choice where you can decide, but this is the maximum limits. Okay, you cannot have more than 50% in the equity if you are 60 years and above. And up to 50 years, you can decide, but yes, maximum is 75%. But auto choice means that the fund manager will decide. Okay, fund manager will decide that how much that he is going to put. into the investments. Here you don't have the alternative investments, you have only 3 asset classes. So there is one portfolio is LC75, which is life cycle 75, and this is an aggressive life cycle fund, which means that you are allowed up to 75%, but that too up to 36 years of age. Okay, if you are 36 and above, then for every 1 year of age, 4% will get reduced in the equity, and this 4% will get reallocated to corporate bonds and government bonds. So in the corporate bonds, 1%, and in the government bonds, 3%. So for every year, 4% of equity allocation reduced and transferred to 1% to corporate and 3% to government security. This is LC75, which is an aggressive life cycle fund. If you talk about LC50, which is moderate, so up to 35 years of age, maximum 50% is allowed in the equity. And there is LC25, so maximum 25% is allowed in the equity. So why we are discussing this? This is to align with the thumb rule, which says that as your age becomes older, I mean, as you become older by 1 year, okay, your portfolio to the equity allocation or the risky asset should reduce, and you should keep your funds more into the safer to make sure that your retirement is smoother. Okay, now going back to what we were discussing, one more rule which says that this is again a thumb rule. Okay, the thumb rule says that at any point of time, your total debt should not be more than 35% or 36% of your income, because 50% will go into your needs. Okay, now remaining 50% that you are having, from that 35% can go into the debt repayment, and maybe 15% that you can keep for your other wants and other things, or savings and other things. So the guidelines suggest that, and this guideline can be referred to with a policy of IMF, which says that ability to pay ratio. Okay, how much is the ability to pay ratio? From that it has come, and it says that this policy considers the loans with a grant element of at least 35% to be concessional, which means that your debt to income ratio should not be more than 35%. So if you are having total income of 100%, the EMI for the housing loan can be or should be 28% or lower of that. So if you are having 1 lakh rupee income, 50% of that any which way is going to go into your needs. So 50,000 is your daily expenditure. Another 50,000 which is remaining, from that 28,000 can be the maximum housing loan EMI. Okay, if you are having a car or something, another thing, then it can go up to 36%. So everything put together, it should not be more than 36%. Well, suppose, let's say you are not able to meet this criteria, and your EMIs are becoming higher than the 35 or 36% which is identified, then in that case, some of the bankers or some of the financial institutions will allow you to take a loan which is higher than this, so which can go up to 49%. Okay, but yes, in this case, no, you will be charged a little higher interest rate. But at any point of time, your debt to income ratio should not be more than 50%. Because if this is the case, then your daily needs will not be met. So maximum debt that you should have is up to 35%. Yes, it can go up to 50%, but there is a strictly no for more than 50%. Okay, in this section, in this section, we are going to understand quickly that how you can leverage the technology for investments. Nowadays, there are artificial intelligence-based investments, guidance or investment advice which is available. The UPI payments are available, through which that you can do payments very easily. Internet-based banking, mobile-based banking. With the technology, it's very, very important. It has been generally seen that the females or you can say women generally are not very much, I'm not talking about every woman, there are so many women which are very, very conversant with the technology. But overall, generally that those who are the homemakers or those who are not taking active interest in the investments, they either are not very conversant with the technology, or even if they are conversant with the technology, somewhere there is a reluctance to use the technology, because we think that these things will be taken care of by the male members of our family. So let's also understand that what are the things that we can do with the technology. So technology is going to be a game changer in the investing because number one, easily accessible. So many apps are available, so many digital platforms are available. Every demat account is now available online. You can use internet-based banking, mobile-based banking. You can use UPI payments. And this has reduced the brokerage and transaction fees. Okay, recently that you must have seen that many brokers or many service providers have reduced the brokerages uh, because they are using a lot of technology, and with that, the cost has reduced for their platforms as well. Automation and AI-driven insights. Okay, they are employing the robo advisor, they are employing the artificial intelligence-based stock predictions, optimization of portfolio management, and these investments are monitored real time. Okay, they compare with market trends. Based on the market trends, based on the historical performances, based on the trends in the market, what will be the possibility of generation of the returns in the future, and how the portfolio is going to change and the portfolio performance is going to change, that is being taken care of. And the investments, the entire piece is forecast and predictions done. There are algo based trading, okay, where the algorithm is written or an equation is written, and based on that the investments is being done. There are batches which are using, there are blockchain based transaction. So lot of technology which is coming up, okay, and this ultimately helps in better decision making. So AI powered insights, risk analysis, all of these things that it's going to be helpful with. Now, technology-based platforms, technology-based services is available and provided almost by every stockbroking firm, every trading firm, every bank, every demat account. Okay. Some examples which I've written on this slide is Zerodha, Grow, Upstock, ET Money, Kuvera. But so many which I have not also mentioned over here. Okay, Sher Khan is there, Motilal is there. So any traditionally no any traditional stockbroking firm also, if you see nowadays, they are having the trading accounts and everything which is available online. Not only that, many of the news, analysis of news reports, and suggestions that they are going to give you, that's going to be powered by artificial intelligence. With the help of chat GPT, this has become even much more easy. Generative AI, okay, this is becoming much more easy for the people. So not one or two specific, but you can see every stockbroking firm, every bank, every demat account, they are providing AI based suggestions. Okay, and artificial intelligence and big data is again going to change and changing the investment strategies, not only of the portfolio managers or the banks or the investment firms, but also of the investors, also of the individual investors. So many investors do take the services of financial planners and financial advisors. Okay, AI based algorithms help in selecting the stocks. They help in identifying whether the stocks are good or not, for a particular risk appetite, whether this stock is good or not. Okay, it can help in earnings call, it can help in media sentiments, it can also help in analyzing that currently what is the sentiment in the market, and is this a good time to purchase a stock or not. Okay, it does the sentiment analysis. It can scan the news, it can scan the social media accounts, it can scan the historical financial statements, it can scan the predictions in the market trends. Maybe it can also do the analysis based on the scoring pattern which can come from the analysis by various people or various advisors. So let's say there are many people who are giving their advising and all. Okay, they are coming up on the news channels and like that. So AI powered tools can collect the news, can collect the analysis done by others also, and then come up with a model, and then can come up with a earnings call, or whether you should be buying a particular stock or not. And not only that, they can also create a portfolio for you. For example, how much that you should be keeping in equity, how much you should be keeping in real estate, how much you should be keeping in mutual funds and like that. Okay, so AI powered portfolio management is also being done. It can predict the market trends. It can do the risk management, not only at the micro level, but also at the macro level by analyzing various countries' GDP and other macroeconomic factors. So what's the GDP rate in India versus US versus China versus Australia or New Zealand or Japan? What is the forex reserves in each of these countries? What are the trends in the interest rates? What are the trends in the inflation? What are the trends in the currency market? Macroeconomic factors from different countries that it does the analysis. It can suggest you that what will be your best take. Okay, algorithmic based trading. I just talked about the algo based trading, high frequency trading, which is called as. Okay, and personalized portfolio management also it can do for you. There are some robo advisors. Okay, based on the artificial intelligence, the robo advisors are also available, and they are providing the personalized services for the portfolio management, and they can not only help in allocating the portfolio, but also the strategies for rebalancing of the portfolio based on the historical data and the future sentiments. So data driven strategies for allocation of the portfolio, for rebalancing of the portfolio. Rebalancing means that what was your existing allocation and now whether you should change the allocation to the portfolio assets or not. Currently, let's say if you are having 30% into equity, then you should be making it 35% or you should be making 25%. So rebalancing of your portfolio. Currently, you may be having an investment into, let's say, one particular stock, let's say Infosys. So should you be continuing with Infosys or should you be taking another share or should you be increasing its portfolio? So it can give you the rebalancing of your portfolio. It can also suggest some low cost alternatives to you. And this is relatively much cheaper than the traditional wealth managers. Okay, so these are some of the AI based mutual fund recommendations platforms which are available, which are purely based on the robo advisors. Okay, however, though they are good, they are providing a lot of analysis and services and strategies, there are risks because this is a digital platform, and cyber security or the digital security is one of the major concern with this. So common pitfalls or common challenges is that if you start using AI, make sure that you are not over relying on the AI. You are using your own personal preferences. You are also using your own analysis. You are also taking the advice of others. And some of the investments that you are doing that should be manual without using an AI. Or if any AI investments are being done, at least keep on a tab. Okay, keep on checking that what is being done. So don't fall into a trap of over reliance on AI. There could be the cybersecurity threats like phishing, or that could be hacking, or there could be frauds. Now, for that, awareness is very important. What's happening in the market, and it's also very important that no, we should not fall into the trap of these hackers and frauds. We should know that there are multi-factor authentication available. Okay. Too many investment choices. Sometimes this robo-advisor or AI-based investment opportunities give you so many alternatives that sometimes no, we are not able to identify what should we do. So too many choices may lead to the decision paralysis. Now for this, what should be done? So how we can mitigate the risk? So rather than over relying on AI, number one, we should use our brain also. We should be using our own estimations, our own analysis. We should take the help of advisors. And please use only those apps which are regulated by SEBI. That means use the applications provided by the brokers or agents or the platforms which are regulated by SEBI. For cybersecurity threats, it's very important that you activate the multi-factor authentication on the application. Sometimes the biometric will be required, the thumb impression will be required. Sometimes no password on the application as well as the OTP that comes on your mobile, both are required. So two-factor authentication or multi-factor authentication should be enabled rather than just relying on one password, because password can be hacked. But when it is a multi-factor authentication, okay, when it's a thumb impression, okay, then what happens that it's not going into checking from the normal route. It has a separate security parameters. So it's better that you activate the multi-factor authentication. Okay. And when you are having too many alternatives, then better that no, you start with small investments and then increase gradually. So you may start with 5,000 rupees, you may start with 2,000 rupees, you may start with 10,000 rupees, and then you can go for larger investments. So this is about all our concepts that we had to discuss. Okay, I'm quickly summarizing all the things which can lead us the financial freedom, how we can prepare the financial freedom, all the things that we have discussed in the last 2 hours. Okay, I'm going to put it into a summary form in the next maybe 5 to 7 minutes, maximum 10 minutes. But in the next 5 to 7 minutes, we are just going to summarize all the points that we have discussed at this point of time. Number one, set the clear financial goals. Your goals have to be smart, specific, measurable, achievable, relevant, and time bound. So your short-term goals can be for building an emergency fund. Let's say this is for 2 lakhs and time frame is 1 year. Medium term is, let's say you may want to buy a house, let's say 5. So these are some examples. Okay. The first step is set the clear financial goal, smart goals. Second step is that give the highest importance, create emergency fund. At any point of time, you should be having nearly 3 to 6 months of expenses, okay, invested into an emergency fund, which can be the combination of high interest savings account or FD or liquid mutual funds. Okay, and this can help in managing the job loss or any unexpected cost or medical emergency, so and so forth. Next, use the 50-30-20 rule. Whatever is your income, okay, nearly 50% can go into the needs, 30% can go into the wants, 20% can be for the savings and investments. So this is all we have already seen. I've also shared one Excel spreadsheet for you. Okay, you can make use of that and you can check whether your needs, wants, and savings are within the range of this 50-30-20 or not. More the savings, it's good. Okay, so if you can reduce your wants to 20%, then you can save 30%. So that's good. Okay, manage the debt. If you are having a very, very high interest debt, like credit cards or personal loans and all, make sure that you want to pay off them first. Okay, if you have to have a waterfall of payment, which means that whenever the money comes up and where do you want to pay the first, then in that case, the highest interest debt, credit card or personal loan, you should pay first. Then comes maybe the other things. Okay, but this is the first thing that you need to pay. You can also use the smallest first, which means a snowball method, in which that the smallest amount that you may want to pay off first, so at least one tick mark is there in your list that, okay, this much is paid. Or you can have an avalanche method where the highest rate first, that's what you want to pay off. I would suggest that high interest debt payments that you do first. Okay, because that is something that will, if you don't pay, it's going to keep you in the trap of debt payments. Okay, the next is that you invest for passive income. So for long term, for wealth creation, better you invest into the high income instruments. For example, mutual funds or stocks or real estate or bonds. Okay, and you can also make use of rule of 72. Invest for passive income. Invest in such investments which can give you passive income. Stocks should be such that which can keep giving you dividends over a period of time. FD should be such that it keeps giving you the interest over a period of time. Okay, so bonds could be such that it gives you interest over a period of time. Invest into those instruments which can give you passive income, maybe dividend, maybe interest over a period of time. Whenever you are doing investments, keep in mind that you have to cover the inflation first. So any investment that gives you more than the inflation rate, okay, that's better rather than just putting the money into the savings account. So for wealth creation, you will have to beat the inflation. Okay, very, very important to beat the inflation. Diversification, important. Don't put all your money into the one single asset class only. And within the asset class, don't put everything into one type of asset only. Okay, so within the equities, don't put everything into one company's shares. So spread the investments across the equities, real estate, gold, debt, international funds, mutual funds. Okay, maybe mutual funds, maybe it can be equities, it can be equity plus debt, it can be liquid funds, a combination of all of them. Build multiple income streams. So you can put some money into real estate so that you can get rental income. You can put some money into stocks and mutual funds so you can keep getting dividend. You can put some money into the fixed deposits, okay, so that you can keep getting the interest. You can also do some side hustles and freelancing for getting the second source of income. Okay, you can have the second source of income. Very, very important that you can have the second source of income. Now, you can also use technology, use electronic clearing and settlement, automated SIP, automated systematic investment plans, scheduled transactions. Okay, sometimes you can also schedule the transactions for payments and the investments. Same way as we schedule the transaction for payment for our electricity bill or gas bill. Same way we can have a scheduled transaction for SIP. That every month 5,000 rupees will be going in from my salary to the SIP. Okay, you can use the fintech apps. You can use the AI based investment and the technology, but make sure that you understand this technology well and you are well served with the safety and the security with the multi-factor authentication and SEBI approved applications. And shifting from earning to managing the wealth. Don't only concentrate on earning, also concentrate on building the wealth. Very, very important, building the wealth. And finally, living the meaningful life after the financial freedom. Once we are financially free, we can live the way that we want. We can maintain our lifestyle. We can have a purpose and passion in our life. Also, please concentrate on the health and well-being. Okay, health is wealth actually. So yes, we talked a lot of things about money, but very, very important, staying physically and mentally active and fit is very important. Also, we should give back something to the society as we earn, okay, in the form of mentoring, in the form of charity or any other form. If not money, at least contribute the time to the society. And that's how we can live our life financially free, a meaningful life without having any stress regarding how we will be managing our financing and expenses in the retirement age. Okay. Very, very important. The last point is that as we build the wealth, okay, we should also keep in mind when we are not there, this wealth will be going to whom? Most of the people that I've seen have not created any will. Very important, a well-structured estate plan, a well-structured will and trust. If not trust, at least a will should be there, so that when we are not there, at that point of time, the money that we have built, the wealth that we have built, goes to the people whom we are actually wanting to give. Maybe our legal representative, maybe our heirs, maybe our children, maybe some NGO, maybe some social work. So whatever is there in your mind, a will is a must. A financial legacy plan. Okay, I would just request you that take this as an exercise and draft a basic financial legacy plan for your family. And a registered will is considered to be the best thing. Okay, very, very important that you create a will and get it registered. Okay, so with this, I hope in the last 2.5 hours, whatever that we discussed is going to be useful to you. Thank you so much. Thank you so much for being with me. And I hope whatever we discussed is going to be useful to you. Thank you.